So I think as I'm going through SPY, is that good with the
Yep.
disclaimer?
Yep. You can go take it over now.
All right, let me share my screen here. And I think what we'll do is cover this um, at the money straddle report. And what this report does is looks at the money straddle in a particular stock. So we took SPY as our example, and it captures the performance of the straddle using different date ranges. Okay, during it during the week. Okay, so couple things here you'll see here. These are looking at week by week, and within the week, we capture the straddle and say, well, how does the straddle in SPY? So this would be the at the money straddle that covers these days. How does it perform from Monday to Tuesday? Okay, so you'll see here it's a hold, 1 day hold, and we do capture it Monday at around 10 a.m. We take the first snapshot, so you'll get a whole days of Monday actually to Tuesday at the end of the day, and then we see how did that straddle perform? Did it from those two snapshots? Did the straddle increase in value? Did it decrease? Does it tend to open up high and then decay? How does that straddle tend to perform during a particular weekly range? Okay, so here you could see if we start from Monday to Tuesday, Monday to Wednesday, 2 day hold, Monday to Thursday. How about the entire week from Monday to Friday, right? How does this straddle tend to do? So if you took the nearest term straddle that covers those days, right? So that's what we're looking at. What is the nearest term straddle? But that expiration has to cover those entire days. So if we're looking from Monday to Friday, that would have to be a weekly, can be a 0 DTE, right? Because we're tracking exactly that same straddle, those same options. Tuesday to Wednesday, right? So that would have to exist from Tuesday to Wednesday. So it wouldn't be a 0 DTE. It'd have to at least exist for 2 days because a 0 DTE expires same day. Okay. Same thing Tuesday to Thursday and so forth. So you could see here, we try to cover different combinations of date ranges within 1 week, right? So even Thursday to Friday, you'll see that that's a 1 day, right? Now we have all these different hold periods throughout the week. And then what we'll do is for each week, so you can see here the week of July 1st, the week of June 24th, the week of June 17th, we captured that performance, right? So Monday to Tuesday, the week of July 1st, the straddle lost 3%. The week of June 24th, the straddle lost 21%. However, June 17th, the straddle gained 27%. So now we could just take a look at the last, I think we're doing it, like 13, going back 13 weeks, just to see what percentage of the time the straddles gained, right? And then of course, if they gain 36% of the time, then 64% of the time the straddle lost value. So here we see 36% of the observations going back to April 15th, the straddle gained, right? And it was positive. On average, the gain was 8%. So what does that mean? Well, if you did that straddle, on Monday, let's say at 10 a.m. And we can see here, hold on. I think if you click view, it'll show the data. So here's the data. So you can see here at 10 a.m., starting to July 1st, and close it July 2nd, 3:59. Right? We see what the stock did. The stock was 544.79. The stock ended at 548.72. So it gained a little bit less than a dollar. The straddle, well, here's the call price and the put price, 276.245. Right? We were looking at, it tells you here the strike, 545 strike. The total value, if you bought each one call, one put, $521. So it's suggesting a 1% premium above spot price. So if we took the premium above spot price 1%, you can see that the stock moved 0.7%. So the call, right, increased in value from 276 to 457, but the put decreased from 245 to 49 cents. So it didn't go to zero because the straddle probably still has time premium. It didn't expire that same day, but it did decline in value, right? Because if you start out the value 521, the next day the value is 505.50. Well, it lost $15.50. So mark to market, it lost $15.50 from, you can see July 1st to July 2nd, which translates to a 3% decline in that premium, right? 3% decline. So that's from Monday to Tuesday holding and at the money straddle. Of course, here we're tracking actual option prices. So you're not going to find, exactly if the spot price is 544.79, you're not going to get a strike at exactly each spot price at that moment, right? They don't list options at every penny, right? So we're looking at the closest straddle, which would have been $5. I'm sorry, $545, which is 21 cents away. All right. So another thing here is when you open it up, we start comparing it to a different strategy if you hedge some of your delta, because options have a delta, which is that initial directional risk for $1 move in the stock, right? So to hedge a $1 move in the stock, you would offset your delta with the underlying stock to an equivalent amount of underlying stock. Okay, so if you're long 100 delta, you sell short 100 shares, and then in theory you have a hedge for a $1 move up or down. Okay, so what if we just hedge that initial delta? Well, here it shows that the loss would have been a little bit greater, $23.37 and a 4.5% loss. Now, when the stock moves, the stock could move, and then your option strategy has a gamma. So you are hedged. If you're hedged for $1, if the stock moves more or the options decay or whatever, now you have to recalculate a new delta and get delta neutral again. So that's trading your gamma. Now, here we call that daily delta rehedge. So you hedge the initial delta, and then at the end of the day, you rehedge again to go out end of day delta neutral, right? So the idea there is you hedge your initial delta, but at the end of the day, you want to go out delta neutral for the following day. So you're going to trade your gamma end of day. using that strategy, you could see on the week of July 1st, so this was looking at July 5th options expirations because it had to cover these two. It lost 9.5%. So now we have 3 different ways to look at that straddle. Just doing the straddle outright, holding on to it, or hedging the delta and then waiting to the end, or trading a delta neutral, rehedging the delta end of day every day. In this case, it would be just, I think like 1 day or 2 days. So if we slide down here and we're doing it week to week, so you could see sometimes it worked, right? Sometimes it didn't. We're looking at laws of averages. We're looking at what tended to happen, right? Because if something wins every single time, all the time, it would have been easy, right? But we're seeing like what tended to happen. Now we have side-by-side comparison week to week of these 3 different methods of trading a straddle. And then we could slide down here and then just compare them, right? So what happened here was out of the last, I think we're looking at 13 weeks in here, 12 or 13 weeks, the stock increased 75% of the time. So it was basically an uptrend, it looks like. The average return week to week was 0.1%. So how do we get to that? Sorry, the average return from the Monday to Tuesday period, right? So this would be at 10 a.m. on Monday to end of day Tuesday. Okay, that's what we're tracking here. So we see here 75% of the time the stock increased during that period. The average return was 0.1%. Now, to get to that average, keep in mind that implies that each week, right, from Monday 10 a.m. to Tuesday end of day, the same notional, you had the same notional risk at the start, meaning that week 1, if you risked $1,000 worth of stock, right, you bought $1,000 worth of stock, so whatever it ended up being in shares, the total risk was $1,000. That means the next week you risked $1,000. No matter if you made or lost, you risked 1,000, 1,000, 1,000. So you had to always look at it as notional neutral, right? So given that, you see that the gain was 0.1% on average week if we took all those 12 weeks. Okay, so 0.1%, 0.1%, 0.1%, okay, on average. The median return, so the average could get pulled up or down because of maybe a certain outlier, because the stock doesn't move exactly the same amount up or down every week. You could have some weeks it moves up 1%, some weeks it moves down 3%, sometimes up 2%. So the average itself could get skewed because of extreme moves or outliers. So what is the median return? The median return here is 0.2%, meaning half of the observations were below 0.2%, half of them were above 0.2%. Okay, that's the median. And then we get a standard deviation around those returns. So yeah, we did get 0.1% on average, but how much did the stock move around that average, right? How much did the returns move around that average? You can see it's 1%. Okay, so the wider this is, the more risk this is. You could get an average of 0.1% and the stock move around 10% up and down, 20% up and down, right? Or 1% up and down. So how much variability do we get around that average? That's what this is, 1%. Okay. So let's compare that now to the option strategies. So this option strategy, keep in mind, a straddle is not a directional exposure. The idea there is that you're taking a delta neutral approach. It's like a directional neutral approach. A straddle from the buy side is you want the stock to move, right? You need it to move in either direction because you got to call in a put. So if it moves down a lot, well, your put will gain in value, your call will decrease in value. But if the gain in the value in the put exceeds the loss in the call, then that straddle increases in value. If it goes up a lot, your call will increase, your put will decrease. So you want the gains in your call to be offset by or exceed the losses in the put, and then it'll increase. Or if the stock just sits there, they can both lose value. So that's what the straddle is. Okay. How often did that straddle gain in value? Well, that happened 33% of the time. If you just bought the straddle and sat on it, right, and closed it out at end of day Tuesday. How often did the strategy gain value if you did it delta neutral? So you involved the stock component in it to hedge off the delta. Well, that was also 33%. What about rehedging? 33%. So really, all three strategies looks like it gained in value 33, 1/3 of the time. What about the average returns? So the average returns here looks like the best one was with no hedge. So just not involving the stock. Gain on average 6.7%. Delta neutral 6.5%. And if you rehedged it, 4.5%. Okay. So just letting that straddle go, not involving the stock, looks like that was in the last 13 observations, that was the best performer. What about the median return? So you could see your median return is down 2.8%. Here 5.4%, here down 5.6%. So the interesting part here is like that this strategy, even though it only paid off 33% of the time, 1/3, that's the win, 1/3. But on average, if you did it all 13 times, it was a net gain, 6.7%. Right? And that's because we could just look at it. Some of these wins were pretty big. Here's one, 73% winner. 28%, 26% winner, 26% winner. So how's that the case? Keep in mind that 1/3 of even though it gained 1/3 of the time, that doesn't mean that every loss and every gain was the same, right? The times that it gained in value could have been so great that it covered the losses for many of the times that you lost. Like think about it as spinning a wheel, and if it lands from 1 to 9, you lose $1, but if it lands on 10, you win $1 million. Well, even though you got a 10% probability of winning, the time that you win is going to offset all those losses and then some. So this is what it's saying, that yeah, your losses, you're going to carry more losses, but the gains looks like when it offset and then gain above that amount to result in an average gain overall, 6.7%. If you did a delta neutral, 4.5%. I'm sorry, delta reach hedge, 4.5%, delta neutral, 6.5%. And you could see here the median return was down 2.8%, down 5.4, down 5.6. So what this is saying is that there is a positive skew. Something in the average pulled it up above the median. It's probably this one, so up 73%. Because you could see here, we didn't have any down 73%, right? Like you could see the losses here on the greatest, I see down 21%. But we had 73% gain here, 26% gain. So these pulled the average up. So then what about the standard deviation of the return? So you could see here 25% unhedged, 27%, and daily rehedged 22%. So why is this standard deviation so much greater than the stock? Yeah. Well, the stock in SPY, the market in one day, it'll move 1% up or down, right? That's a standard deviation. But the options are much more, they're leveraged. They're much more sensitive to a stock move. So a stock can move, in SPY, you have, whatever, 1% move is $5. But that option, the money option could go, double, right? It could go, I don't know, from 3 to 6 or even more. So the options themselves, they're leveraged products, they're lower priced, they're sensitive to stock movements, so they'll have bigger standard deviation, right, than the stock alone. It's a leverage, you can see here, it's a derivative, it's a leveraged product. So, well, I'm going to stop there. We're right up at 9:30.
Awesome job, buddy.
Yep.
I did put both a link to the registration again for tomorrow's IBKR webinar and a link to the IBKR library that has all the webinars you've done. Great job as always. Nice way to start the week, D. Yep. Thanks everyone for joining. Great job, buddy.
Thanks everyone. Have a good trip.